All right, yield nerds, welcome to Studio Yield Nerd episode 186. I just bench pressed 450 pounds and caught up on a fireside chat with Chairman Warsh, the incoming Fed chair. Well, I neither bench pressed nor had the real chat with Chairman Warsh, but suppose I did, and suppose he said what I'm about to tell you. How would I change my portfolio and what did I really do? Let me walk through and see where we go. I'm sharing my education. We're at 496 subscribers. If you're new, please use the Income Investing Roadmap. And there are a couple of other playlists and consult with them as you see fit. But the most important thing, please do not believe me. Do your own homework and we'll go from there. Four parts to today. The first is I'll show you how my portfolio is doing compared to the NASDAQ and the Russell. We'll talk about this accord that has come in the news. Chairman Warsh has indeed talked about how there could be an accord between the Fed and the Treasury, and what kind of effects could it have on the market, the fixed income market and the equity market, and what kind of checks and balances would be there for the accord to either come to being or not come to being, and my changes based on that. As you can see, in the last year, I have almost quadrupled my allocation to equities, and that's me and my buddy Warsh picnicking outside the stock exchange. And as far as my own exchange goes, I am crushing it, and I'm very excited about it. You can see that year to date, I'm up 13.85 something percent, while the NASDAQ is down 2 3/4, and the Russell is up only 5. So something's working in what I'm doing and I'm hoping the magic continues. All right, my friend Warsh, tell me more about this accord thing you're talking about. And the Chairman Warsh says, well, let me tell you while your coffee is on fire. I don't know what's going on with that. Before I continue further, I want you to know that this is not investment advice or tax advice, and I am not a wealth management advisor. I don't do politics. I don't pitch products. I learn every week, and I'm sharing my learnings. Speaking of learnings, here is a Bloomberg article. Chairman Warsh talks about a Fed Treasury Accord, and people are starting to talk about what does it mean and what can we do and what can't we do. So here is a crazy scenario. What I'm about to describe is extremely unlikely to happen. Somewhere between a daydream and a nightmare is reality, as they say. I am preparing for that reality. You do you. That's Treasury Secretary Bessent meeting with Chairman Warsh, and the pact is made on a couch made of money. And the pact goes something like this. Chairman Warsh calls Secretary Bessent and says, yes, Secretary Bessent, you want lower interest rates? Got it. Here it goes. And he hangs up the phone and he looks at the yield curve and he says, October 2023, we had these huge interest rates because we were trying to bring down inflation. And we did a masterful job. And as time progressed, we kind of tamed it down to where it is today, which is February. And the job market is doing pretty well. Inflation is there in some parts, not there in some parts. It is time to juice up the market. And the argument being AI will give us growth. And because AI is going to give us growth, we need to encourage more investment to make America competitive. And the way we do that is to bring out a big, big weapon that we call a cap. The cap on yields works something like this. There is an artificial cap placed on short and long-term yields. Now, how would such a short and long-term yield cap work? The Treasury would say, if there is an auction, anybody who wants more than 2.5 and 3.5% yield, we're not going to give it to you. We're just going to print more money and buy that until the only bonds left in the auction pay whatever that cap is. Now, I just made up the cap. I made up the cap to be 2.5% short term and I don't know, 4% long term. Maybe the real cap is a different number, but this is conceptually how a cap would work. So the government brings out the money printing machine and buys up everything where the bid is above that number. So when you, me, and anybody else goes to buy, their yield is capped. If that sounds crazy to you, look at what Dolly did. I wanted to have a fireside chat with the incoming Fed Chair Warsh. It set the stock market on fire, kind of, sort of. So here's what I did. I went to my most trusted financial advisor, Google Gemini, and said, hey, if there was indeed a pact and yields were capped, and that is going to happen in 6 more months, what should I do to position my fixed income portfolio today? And what should I do on equities? And I got a 6 month clock, tick tock, tick tock. Well, let me tell you the first thing that logically I would do as I picnic with Chairman Warsh. I would say, okay, my 10-year paid 4.25%. Absolutely crazy news. February 13th, the 10-year is down to 4.04%. So the market pretty much is not believing any of this, which is pretty wild to me. I like it because it gives a rare opportunity. The 10-year that I did buy at 4.25% is up 6% because today the yield is only 4.04 for the 10-year. Now, if I did buy the 10-year at 4.25, and if I bought it at par or close to par, then indeed, when the high end is capped at 3.5, the 10-year would trade at 125, giving me a huge gain. So the thought here would be on treasuries, start buying more of the 10-year if you truly believe there is a cap. And the market doesn't believe it, but I kind of like where it is going. On the short-term side, here's what's going to happen. My short-term T-bill matures, but I can't put the money anywhere because there is a cap on the short-term yield and cap on the long-term yield. So it doesn't look like T-bills are the good place to be. I need to get out of them, buy a little bit of 10-year treasury, but the big deal comes to agencies. Agency bonds that issue a coupon over 3.5. Now, why do I use 3.5? I told you I pretended there is an artificial short-term cap of 2.5, artificial long-term cap of 3.5. So if the long-term yield is 3.5%, why would the agency pay you 5%? They will not. If it is a callable bond, which all agency bonds are, FHLB, FFCB, they are called Bermuda call, as you may remember. You can call them anytime with 10 days notice, and all of those will get called. That means many of my agency bonds will come back to cash, and I'll have to figure out what to do with them. What about corporates? Any investment grade corporate bonds that pay over that 10-year will appreciate massively, only because corporations can't really call the bonds real quick. And if you decrease interest rates, corporations can borrow money very cheaply, and they would therefore invest more theoretically, and they would, grow faster theoretically. And I keep using theoretically because you don't know and I don't know. But in concept, bonds that pay higher than what you can get on the 10-year would appreciate very quickly. So corporate investment grade bonds would become a very interesting place to be. Munis, any muni with a coupon over 2%, which is next to nothing, practically everything will qualify here. So munis that are callable will get called very rapidly and get reissued at a very low interest rate. So what would I do? I would go to munis with callable dates about 5 years out, 7 years out, because those will appreciate very quickly, especially if they pay a coupon north of 4%. What is the wild card? The wild card, unfortunately, is if there were a quote pact, and if it was done the way I made up the pact was going to be done, or anything close to it, then there is a huge amount of money supply. We literally will be sitting on couches made of money. That means inflation would go higher. If inflation goes higher, then tips will suddenly become a huge moneymaker. Now, I don't think I'm going to buy tips right away, but around May, when the current chair Powell exits and the new chair comes in, that might be an interesting time to buy tips. I don't know. I'm going to keep educating myself. So if that is the fixed income strategy, mind you, the summary of the fixed income strategy is to increase duration in treasuries, buy agency bonds, and buy investment grade corporates, and buy munis that are not callable for 5 years. That is what the research says. For me, you do your own research. Now, what do I do on equities? On equities, there is a very different outcome. And this is the great wealth management advisor called Mr. Gemini. Mr. Gemini says, hey, you know what? If interest rates drop, those sectors that require a lot of money to burn will find cheaper money, so you should be overweight on tech. And I go, interesting. Now, what about financials? If interest rates drop, banks will find it harder to make money because they make the differential in interest called the net interest margin. And if it is compressed, then banks will have trouble. So run from banks. And I'm going to come back to that comment, run from banks, because I'm going to contradict Mr. Gemini here. And I'll do my own research. I'll tell you more. But it is indeed pointing to real estate investment trusts. Why? REITs have a lot of debt. If money is cheap, they can then pay off some of that debt, decrease their interest expense, and give it off in dividends. So I sit there and go, ooh, okay, I don't own a lot of REITs. Let me see what's out there. And the next thing that would happen is any kind of hard assets or hard asset proxies, a barrel of oil, a gallon of gas, those things would become very expensive. Consumer staples could get hurt, but those with pricing power, where inflation will be passed on to the customer, will win. So, what does that mean to me? I then started researching. I don't quite buy this. Banks are going to get crushed because not all banks depend on that net interest margin. And so I'm saving you some of the prompts. I'm actually going to post the link to my Google Gemini query where I toss and turn this concept some more. And I asked the question, wouldn't there be mid-cap banks that would get bought out by the big banks because money is cheap? And Gemini was like, well, I suppose that could happen. And I said, well, among mid-cap banks, aren't there banks that aren't totally dependent on net interest margin? Aren't there banks that have non-interest income? And it said, oh, funny you say that. And so it came up with a bunch of banks, and then I had to do my own homework, read their 10Qs to see if indeed their non-interest revenue is high, and also verify if they give a good dividend. And so I ended up with a handful of banks that do not have a lot of exposure to interest rates, pay a high dividend, and have a low debt. What are these? A dozen banks, if I may say. And these are small and mid-cap banks that I expect the big banks to eat up, or I expect them to continue paying dividends, which I will happily take. Some of these bank names you may never have heard unless you live in that neighborhood. Old National Bank, ONB, UMB Financial Corporation, Worstown Financial, I didn't even know this existed. Service First Bank Shares, never seen one of those. People Bank Corp, Cullen-Frost Bankers. As you can see, I'm up and down a couple of percentage points on these banks. I just picked them up and I'm accumulating them as time goes on. But there are some other banks where I have indeed picked up a healthier share. FIBK, First Interest Bank System, Regions, UBCP, Toronto Dominion, USB, and Westbanco. These aren't small, these are slightly bigger banks, but I am padding up my dividend income with these bank shares and hoping for the best. So then we have to ask the question, wait a minute, you are saying Chairman Warsh can just make a phone call to Treasury Secretary Bessent and say, here you go, the caps are in place. Is there any check and balance? Well, of course there is. So here comes Mr. Gemini. And I say, hey, can the Treasury just, make a call, and can the FOMC just put a yield cap without a vote? I thought there was a vote. And it said, yeah, well, you're right. There are three ways to do this. One of them indeed is to set an interest rate cap, but you need 7 out of 12 votes. The second is you can just start printing money, yield curve control, and that would also put a cap on the short and long-term side. But there you would need a majority. Now we are starting to move to majority. And there is also a quote emergency that can be declared. There you just need the Treasury Secretary and 5 board governors. And last, you could have an informal agreement with some consensus, and it's a very loosey-goosey deal. So one of these levers could be pulled, and there could indeed be a way to get there. And I was like, wait a second, one of the levers only required 5 votes. Tell me more about that one. And in that scenario, you only need 5 votes. And, the question then is, it looks like we can get to the 5 votes. And I had to ask Mr. Gemini, hey, do you think there are 5 votes? Who's going to vote for it and who isn't? And it said, well, let me tell you. The path to 7 votes or 5 votes, 3 of them are in the bag, so to speak. Moran and Waller and Warsh, you know they're going to vote. What about 4 more? Well, those 4 will need to come from these 6. So you have to flip 4 of these 6. And, there are true swing voters. There is Neil Kashkari, Anna Paulson, Philip Jefferson, and Lisa Cook. They go dovish, and sometimes, it could happen. Now, are all 4 going to swing? Unlikely. And then there are these 2 who are pretty much hawkish. And so the real question comes down to this, and this is the big deal. If the Fed chair says vote this way, there are some Fed members who usually will disagree in private, and in public, they will just vote with the chair. If indeed Chairman Warsh were able to flip 3 of these 4, that would be the pathway. So then the question is, assuming that happens, what do I need to do? Well, it looks like there are 3 paths, and it's not going to happen with a clean 12-0 vote. It's going to happen more with a 5 vote or a 7 vote scenario. The 5 vote scenario is very risky. It's seen as chaotic, and it could drive up the price of gold. There is another word behind gold, which I won't say. It rhymes with blip-blop coin. And on the 7 vote side, here is the interesting part. Small cap banks are big winners in this scenario because they will get gobbled up by the big banks. And that is why I bought those dozen or so small cap banks, because I see an opportunity there. So what are my trades? You saw my laundry list of small cap banks, and I've been buying them by the bucket loads. My algorithm picks winners, but I do focus on small cap banks these days because of my research. And I do have some dogs. I mean, at the end of the day, these are really small allocations on day one, and I use my algorithm to allocate more, meaning my previous trade has to be profitable because before I put in my next trade, my overall portfolio is up over 13%. Hey, before you do anything, make sure you do your own research because even a broken clock is right twice a day. And so I don't want you to take my word and do anything. Do your own research, and thank you for watching Yield Nerd.